Okay, so the Federal Reserve just did something that, well, on the surface, it makes almost no sense. For the second time running, they've cut the benchmark interest rate, 25 basis points. Now, usually, you'd expect aggressive cuts when the economy's tanking, right? But right now, stocks are absolutely roaring. Gold's near all-time highs. Bitcoin just had this huge rally.
Hmm.
It's confusing.
It really is. And it creates this tremendous dilemma, not just for the Fed, honestly, but for you as an investor. Because
Hmm.
historically, when the Fed starts cutting rates while asset prices are, this high, it signals they see something fundamentally broken, something under the surface the market is maybe ignoring right now.
Right. And that's exactly our mission today. We're going deep into the source material here. We want to figure out the why. What are these specific job market fears driving this? And really crucially, what do these big policy shifts like the end of quantitative tightening mean for your housing plans, your stocks, and that long-term play in hard assets like gold?
Yeah, this is the conversation we need to be having
Mhm.
because the historical patterns, they suggest this is the start of a full rate cut cycle, and that fundamentally changes how you need to approach the next couple years.
Okay, let's unpack that right away. Why the panic? Why cut rates now when the big headline growth numbers still look, well, decent?
The simple answer is the U.S. economy is slowing down,
Right.
and probably faster than those top-line figures suggest. But the core fear, the thing really forcing the Fed's hand, it's the labor market, it's the health of jobs. They're looking at data that is flashing some serious red lights.
But hang on, the official unemployment rate is still, what, around 4.3%? That's historically pretty low.
Mhm.
So what specific data are they prioritizing? What are they seeing that's making them jump over those, delayed official reports?
Well, they're leaning heavily on alternative data because, with the government shutdowns, those key official employment reports got held up. So the Fed's looking elsewhere. And the picture, it's pretty grim. We're seeing data from Bank of America, for example, showing small business hiring has dropped by 7%.
Hmm.
And seasonal hiring for the holidays, it's at the lowest rate since 2009. Think about that 2009, the Great Recession.
Wow, those 2009 comparisons are definitely chilling.
Yeah.
But there's a new factor this time, isn't there? A headwind we didn't have back then at all. Artificial intelligence, AI.
Exactly. And this is where the story gets really complex, I think. Companies aren't just slowing hiring because of costs. They're putting in place actual hiring freezes because of AI. We all saw the news about Walmart, right? One
Yeah.
of the biggest employers globally. A 3-year hiring freeze. And their reasoning was pretty explicit. AI is going to fundamentally change jobs, reduce their future staffing needs dramatically.
And that idea, replacing a potential hire with, I don't know, an algorithm or a bot, that's happening across different sectors, right?
Yeah.
Not just retail.
Oh, absolutely. Walmart's the big headline, but the sources suggest tech admin functions. They're seeing rapid implementation. Companies are realizing, hey, we can automate whole layers of middle management, back office stuff using the AI we have now.
Mm.
And that creates this really tough structural problem for the Fed. Because their usual tool cutting rates to boost hiring, well, that doesn't fix jobs disappearing because of technology.
Which brings us right back to the Fed's big balancing act, their dual mandate. They have to manage inflation and keep unemployment low. So if those two things are pushing in opposite directions, which one gives?
Precisely. You can think of the dual mandate like walking a tightrope, maybe. If inflation is, say, fire on one side and unemployment is ice on the other, the Fed usually can't fight both at the same time effectively, and right now, they're clearly choosing to focus on the ice, on the
Well,
job market, even if that means risking, fanning those inflationary flames down the line.
let's touch on that inflation part. If current inflation is around 3%, why is fanning the flames such a big worry? Isn't 3% kind of okay?
Well, that 3% figure, it's a bit misleading on its own. It doesn't account for the compounded effect. That 3% is building on top of the really high inflation we saw from, 2020 through 2023. Real costs, the stuff people actually buy, have shot up hugely over the last 4 years. It's eroded savings, and it makes life incredibly tough for anyone who's maybe underemployed right now.
Underemployment.
Right.
That official 4.3% rate doesn't capture the person with, say, an engineering PhD who's driving for Uber because their sector's frozen.
Exactly that. The 4.3% masks this reality for a lot of people. People with good qualifications, good work histories, forced into low-skill or part-time work. So cutting rates now. It's meant to stimulate borrowing and spending, create some short-term jobs, yeah. But the trade-off is potentially worsening that underlying compounded inflation, which makes the cost of living even harder for those same underemployed folks. It's a real Hobson's choice, as
Right.
they say.
Okay, so this job market panic has clearly triggered a huge monetary policy shift, way beyond just the interest rate itself. which brings us to quantitative tightening, or QT. What's the signal from the Fed about running off their massive balance sheet?
They've strongly hinted that QT might be ending soon. Quantitative tightening, that is. To make that simple, let's use that classic swimming pool analogy. The economy's the pool, the Fed controls the water.
Right. During the crisis, they did quantitative easing, QE. Flooded the pool with water, creating money to buy bonds.
Exactly. So QT was the reverse. But it wasn't like they were actively draining the pool. It was more like letting the water level drop naturally. They stopped replacing the water that evaporated, meaning they let the Treasury bonds they held mature, and the cash just disappeared from their balance sheet, letting the economy sort of dry out a bit to fight inflation.
Okay, so stopping QT means they might start topping the pool off again,
Yeah.
keeping the water level steady, or even adding more.
That's the implication. The signal is they might start replacing those maturing bonds.
So the whole money printer is turning back on idea. It's not totally off base then. This is a clear shift away from tightening.
It really is. It signals they feel they can't sustain that liquidity reduction anymore. And this isn't just a short-term thing either. The sources we looked at show Jerome Powell basically admitting the long-term plan is to start expanding the balance sheet again, starting in 2026.
Expanding it again. His justification was something about the balance sheet needing to reflect the growing size of the U.S. economy, right? Is it
Yeah.
solid reasoning right now?
Well, that's highly debated, isn't it? Many analysts look at that and say, hang on, is that real growth or just nominal growth puffed up by inflation?
Yeah.
The reality, I think, is the U.S. government has this massive need to borrow money, a huge hole to fill. And someone has to buy all those U.S. bonds to keep interest rates from skyrocketing. If global buyers like foreign central banks start stepping back, and we'll get to why they might be doing that, who's left, the Fed becomes the buyer of last resort, effectively. So expanding the balance sheet in 2026, it's pretty much code for more QE, more money creation to help finance the government.
That's quite an implication for the future money supply.
Okay.
Well, let's connect this back to asset prices. They're already running hot. Stocks first. The S&P 500 has been on an absolute tear, up 30% just since April lows. That works out to what, 15% annualized over 5 years? Incredible.
It's definitely way above the long-term historical average return. And what's really interesting now is the split you see in the forecast from the big banks. You've got the bulls, who are really aggressive. Bank of America, Morgan Stanley. They're calling for S&P 500 at 7,200 through 2026, another 8% jump. And they're pinning that mostly on corporate earnings growth and this massive AI expansion narrative.
But then you have the cautious voices, the historical realists, saying, hold on, 15, 20% year forever, that's just not sustainable.
Correct. You look at Goldman Sachs, JP Morgan. They're forecasting much, much smaller returns, like 3% to 6% annualized over the next decade. Their argument is pretty simple. History shows major market peaks are often followed by long periods of low returns. They look at current valuations, the debt levels we just talked about, and basically argue the last 5 years were an anomaly, due for a big correction or at least a reversion to the mean.
Okay, but what about that historical pattern you mentioned earlier? Fed cuts rates near an all-time high. Market usually trends up 13% over the next year, something like 93% positive returns. Doesn't that bullish signal kind of outweigh the long-term caution, at least for now?
Ah, that's a fantastic point. And it really defines the risk you're taking. Yes, the historical data does show that tendency for the market to drift higher after cuts near a peak, but, and this is the crucial part, that average higher return comes with huge volatility baked in. Specifically, those periods almost always see big swings down. We're talking 15%, even 20% drawdowns along the way.
Got it. So if you're playing that historical pattern, you absolutely need the stomach for a pretty significant drop, potentially. It's not a smooth ride up.
Exactly. And maybe even more importantly, remember that major market crashes often happen because of the underlying conditions that force the Fed to cut in the first place. The crash usually comes maybe a year or so after the Fed starts cutting. It's not the rate cut itself that causes the crash. It's the fragility the cut reveals.
That's a vital distinction. The conditions, not the decision. Okay, let's pivot now. Housing. Lower rates should help the housing market, which has been, well, stuck.
It certainly needs it. Yeah, the expectation is home sales activity could pick up significantly, maybe 10% higher volume in 2026. That's if mortgage rates drift back down into, say, the mid-sixes or even high fives. That would definitely help market turnover, which has been really slow.
Are we actually seeing prices come down much yet, or is it still stubbornly high?
We're seeing some softening. Definitely not a collapse, though. National home values are down slightly, about 1.7% year over year, maybe 2.3% if you adjust for inflation. So yes, prices are easing, but it's marginal.
And the who is buying? The sources paint a picture of a market really only working for the wealthy right now.
It's pretty stark. That statistic about cash buyers tells you a lot. Over 30% of buyers are paying all cash. And the average down payment, it's at an all-time high of $70,000. It shows a market dominated by people with incredibly strong financial positions, which pushes out most first-time buyers, anyone on the entry level.
And where are sellers finally having to get realistic on price? Is it across the board?
Mostly in the middle of the market, it seems. The price reductions are most common in that, say, $350,000 to $500,000 range, luxury homes, where buyers often don't need financing anyway. They're resisting cuts more. Sellers there seem more willing to just wait it out.
And for sellers who aren't being realistic about price or condition, deals are falling apart more often.
Absolutely. About 15% of deals are falling through now. And the number one reason cited, home inspections. It tells you buyers are being picky. And if sellers are unrealistic about the condition or needed repairs, the deal collapses. They really need to price it right from the start, or they risk chasing the market down and getting less later.
Okay, let's shift to the ultimate O trade, the safety play, gold and silver. What does the Fed cutting rates, signaling maybe more easing later, mean here?
Fundamentally, it's bullish for precious metals. Gold tends to do well when real interest rates, that's the nominal rate minus inflation, are low or, importantly, falling. And unlike previous gold peaks like 1980 or 2011, where rates were either super high or had already bottomed out, this current move signals a return to lower rates, just as fears about government debt are really ramping up.
And that debt issue is the much bigger driver here, isn't it? The U.S. national debt. It's the massive elephant in every room that global central banks are watching.
It's arguably the single biggest factor long term. The U.S. debt just hit $38 trillion, projections. $50 trillion by 2030. And here's a staggering fact from the sources. Just the four biggest spending categories in the U.S. budget already eat up the country's entire tax revenue. Everything else, every other government function, has to be paid for with borrowed money, which means relying on lenders.
Which leads directly to this potential confidence crisis in the U.S. dollar, right? If the U.S. has to borrow constantly and the Fed is signaling, hey, we'll just print the money if we have to, why would global central banks want to keep holding so many U.S. treasuries?
Exactly. Why should they? And the data suggests they aren't, or at least they're diversifying. Our sources confirm central banks globally are actively rebalancing their reserves away from the dollar. They made their biggest gold purchases of 2024 just recently, in late October, November. They are systematically swapping U.S. dollars and treasuries for gold, even though gold doesn't pay interest. That's about the clearest signal you can get of a building confidence issue in the dollar's long-term value.
We even saw South Korea, not exactly a minor player, talking about buying gold again for the first time since 2013. That's significant.
Very significant. And all this skepticism, this shift, it creates a potential investment opportunity, not just in gold itself, but in the companies that mine it.
Right, the mining stocks. We've seen a real disconnect there. Why are they flagged as maybe compelling right now?
Because the mining stocks look drastically oversold compared to the metal price. Right now, many major mining companies are trading at valuations that imply gold is priced way lower than it actually is, like below $3,700 an ounce, maybe silver below $43. It's a big gap between the metal's price and how the market is valuing the companies pulling it out of the ground. Suggests a lot of fear, maybe overdone.
So if those long-term drivers we talked about, the debt fears, the confidence crisis, Fed easing actually push gold and silver prices higher, the miners could get a leveraged benefit.
Absolutely. They offer leverage to the metal price. Based on the models we reviewed, if gold were to hit, say, $4,500 an ounce and silver $60 an ounce by mid-2026, you could see really amplified gains in these mining stocks. The projections range from maybe 24% up to 77% increases for some of the better positioned companies. They kind of represent one of the few potential value areas in what feels like a generally overvalued market.
Bringing all these sources together, what really stands out is the central, almost bizarre paradox. You have the Fed easing policy, maybe firing up the money printer again to fight a job slowdown partly caused by AI. Meanwhile, asset prices are already sky high, the U.S. debt situation looks frankly terrifying, and the global reaction is this drift away from the dollar towards gold.
It's a moment of really unprecedented dynamic change, isn't it? The decisions being made now, like cutting rates, they're reactions to genuine economic pain, whether it's job losses from AI or the looming debt problem. But those reactions themselves seem to be accelerating global skepticism about the U.S. dollar and, at the same time, inflating asset bubbles. It's a strange loop.
So here's the final provocative thought we want to leave you, the listener, with. Think about this. AI is being cited by major banks as a massive driver for future stock market growth, the reason the S&P might hit 7,200. And yet, AI is also being cited as a fundamental threat to the human workforce, the tax-paying workforce, leading to hiring freezes and fewer jobs.
So given that dual conflicting impact,
Right.
where does the U.S. government find the long-term stability? Where does it find the tax revenue it needs to support a $50 trillion national debt? If the very foundation of its tax base, the human worker, is being systematically shrunk or replaced by technology that doesn't pay income tax, it raises a really important, maybe urgent question about the long-term viability of the whole fiscal system, doesn't it?
Something to definitely think about. Thank you for joining us for this deep dive. We hope this insight helps you navigate what are clearly becoming very challenging waters. We'll see you next time.